Good morning. It's a great pleasure for me to be here. It's an honor, and have been requested by the organizers to do like a checkup of the Insurance Distribution Directive. You know that the preparatory work to the review of this directive are started. So, which is now the situation of the Insurance Distribution Directive in the digital area. So, if I want to approach this topic, in my opinion, the outline should be as follows. So, first of all, I have to check the resilience of the IDD in the digital era. Why? Because the IDD has been developed without having the digital transformation at the core of the rules. Why? Because the digital transformation started a bit later than the IDD. So then we need to understand if we have to review totally the IDD or is necessary just a fine-tuning of the rules. And the third profile I have to deal with is the interrelation between the IDD and the so-called digital decades, because we will see that European Union decided that we need a new legal framework in order to embed into rules the digital transformation we are promoting within the European Union. I will anticipate my conclusions now, and I will tell you that, in my opinion, the IDD is resilient to most of the challenges arising from the digital area. However, as a lawyer, if I say most, it does not mean all. So I think that we need to fill some gap in the IDD. And then I think that the IDD can play a role within this new legal framework. However, I believe that the IDD, the evolution of the IDD, will not regulate all the aspects related to the digital transformation. So, unfortunately for all of us involved in insurance market, we have to look at the provisions introduced by the IDD, maybe in the revision of the IDD, and the provisions which are now or will be allocated in several other legislative acts which are, in the upcoming process of adoption by the European Union. So now I will explain my train of thoughts. First of all, my first statement was the IDD is resilient to the digital transformation. So here I listed the three digital intermediaries we have seen arising in the last years. The first one, the oldest one, I would say, are the comparison websites. So, in my opinion, the IDD is resilient because the IDD clarified that the comparison websites fall into the scope of the IDD. So, all the regulation introduced by the IDD applies to the comparison websites. Of course, it will be a matter of national law if the entity managing the comparison websites will be considered as an agent or a broker. However, they fall into the scope of the IDD. It means that the IDD provides general principles which apply to all the distribution, and these general principles, such as distributors must always act honestly, fairly, and professionally in accordance with the best interest of their customers. So this principle is flexible enough to allow supervisory authorities and hopefully EIOPA to coordinate a convergent interpretation of the rules in order to, fine-tuning some aspects of the activity of comparison websites which are not full transparent, because transparency is another principle introduced under the IDD, and the customer protection is the general principle in the insurance regulation and supervision as stated under Solvency II. Robo-advice is another, a robo-advisors is a new, an emergent, how can I say, category of intermediaries and advice, form of advice, and the IDD, in my opinion, is resilient. Why? Because the IDD introduced a definition of advice and a regulation of the advice when the advice is related to the insurance-based investment products. Why? Because robo-advice emerged with a reference to the financial products. That's the reason why the IDD is trying to align the regulation on insurance-based investment products to the regulation on financial products. Interesting question is what happens in case of a robo-advice for non-life insurance products. Because we do not have a specific regulation except the general one for this case. In addition, in the PRIPS regulation, which is the regulation on financial products and insurance-based investment products, introduces a principle under which the liability of the provider, of the robo-advisor, of the entity providing robo-advice is not reduced in case of the advice is provided totally or partially with automated tools, such as an algorithm. What happens in case we use an algorithm to provide an advice for non-life insurance product? This is a gap of the IDD, and it's a matter of national law to provide a solution in terms of do we want to extend the principle which is stated for insurance-based investment product and in the PEP regulation, Pan-European Pension Product Regulation, which means we cannot reduce in any way the liability of the provider, or there is an exemption for non-life insurance product. In my opinion, we have to extend because this exemption is not justified. The third one is the peer-to-peer insurance, which is a very fashionable, attractive, maybe romantic idea. So, which means that we have to pool a number of people, and these people without, it depends on the three different models. One of these models is the so-called self-governing peer-to-peer. The self-governing peer-to-peer means that there is an entity who is managing a platform, and through this digital platform, all of us are sharing a fund and are sharing our risk. In case of the event, we have to decide if and how much we have to pay as a benefit, and then I use the word of the founder of this platform. If there are the funds, which is, in brackets, are deposited in a cryptocurrency wallet, bracket, the insured, they use the word insured, is insured. Otherwise, is not insured. So I'm not sure this is, an insurance, but it's important. Why I said the IDD is resilient. The IDD is resilient because the IDD is an activity-based directive under which there is a definition of insurance distribution, and all the entities, legal or natural, carrying out that business fall into the scope of the IDD. So if the entity managing this, self-governing platform is doing an activity consisting in the assistance in the conclusion of the contract, this entity will be considered as an insurance distributor. However, please be aware that the most common model is the other one, which is the broker model. The broker model means that there is a broker, an entity registered as a broker, who is managing this platform, which is collecting money and they call premium, which is stipulating two insurance contracts and managing, the claims. So we have a definition of insurance activity under Solvency II. So we have to check if this kind of activity performed by brokers and named insurance distribution or is insurance. Because if it's insurance, we are in front of a broker carrying out a reserved activity without being licensed. Now, the gaps. You know that now the new trend are these e-platforms. The e-platforms are the evolution, of e-commerce. And now we have these marketplaces which are organized by, entities, some name, I don't know, Amazon, Alibaba, Airbnb, and so on. So, and what they do, they offer, a service which is the organization of the market, but they can also provide insurance services. They can do directly, they can do indirectly. So it means that we need to fully understand which kind of relationship there are between the entity managing the platform, the traders within the platform, and the customers. Sometimes the relationship, the insurance relationship, is only between the entity managing the platform and the traders without an impact on customers. For instance, this is the case of the insurance coverage offered by Airbnb to all the owners in order to protect their houses. But we have also the relationship where the traders, they are selling their products or services, complementing their products or services with an insurance coverage. So in this case, we have first a cross-selling, and the IDD is regulating the cross-selling. The second, we have intermediaries whose first activity is not insurance, who are distributing insurance products. They are considered as ancillary insurance intermediaries. So we apply, in principle, the IDD. However, the IDD introduces an exemption. If the ancillary insurance intermediary are below a threshold, they are exempted from the IDD. So, why there is the exemption? The rationale is that this is an application of the principle of proportionality. If you have a shop at the corner, and the shop at the corner is selling something, a good or service, and some insurance products, why we need to, to ask him to be an insurance intermediary like an agent or a broker? So we have to balance costs and benefits. And so at the end of the day, the criteria adopted by the IDD, a criteria related to the nature of the risk, the risks related to the goods or services sold by the trader, the size of the risk, the amount of the premium are enough. However, what happens with the digital platforms? And we have to take into account another criteria, the scale. The number of contracts that a digital platform can conclude. So a digital platform can do business with a multitude of customers. And so we don't understand why this criteria, which is the scale, is not considered. So in my opinion, this criteria must be considered, and we have to update the IDD in order to cut the exemption with reference to the largest players on the digital market. And the European Union has already done this, because if you look at the upcoming regulation, Digital Market Services and Act, you will see that there are thresholds based on the dimension of these platforms. So, which means that the European Union has already accepted some criteria in order to differentiate between digital players. And then the last part. So, the IDD is now within the 2030 Digital Compass, which is, the way the European Union is doing to create a legislative framework which is able to, deal with all the issues arising from the digitalization. And this framework is not only related to insurance, is an horizontal framework. I'm sorry if I show you this, because this is a list, and I'm not sure I included all the upcoming legislative acts which will apply or will be adopted, or at least is under discussion at the European level. And all these, these new legislative acts will apply also to the insurance sector. Of course, some of them will be, more insurance-related, others will be less insurance-related. However, you will see the number of, legislative acts which will play with us for the near future. And I will spend a few words on the last one, which is the digital finance package. Why? Because the digital finance package is, how can I say, namely directly to the insurance sector. So if you look at this slide, you will see that there are, benefits in introducing this upcoming, regulation on the digital, aiming at regulating the digital transformation. And of course, why? And of course, there are costs related to this digital transformation. Just one topic, in my opinion, is very important to focus now, is the product oversight and governance. So if you look at most of these benefits and costs, you will see that they are all related to how manufacturers are designing the product and how distributors, together with the manufacturer, are distributing, monitoring, and reviewing the product. So, if the product oversight governance means we need to have in place a policy and procedures in order to be transparent and to add value in the process of creating a product, we need to build the product around the interests and needs of our customers. So here there is the regulation, upcoming regulation on data. Which data we are using of our customers? How can we get this data? In addition, we have to monitor the distribution and to review the product. However, through the artificial intelligence and the Internet of Things, we are getting a lot of information from our customers. This can affect the contract law, because the contract law, in most of the contract laws, there is that the policyholder has to inform the insurer with reference to the increasing or decreasing of risk. But what happens in case the insurer already knows that the risk increased because is monitoring the distribution and is monitoring each insurance product? So you understand that this is, for instance, the case of black boxes for motor third-party liability insurance. This is the case of the bracelet for health insurance. You can understand that there is an impact. And then which role will play the Insurance Distribution Directive? And here are, the two opposite, roles. One can be that everything related to the insurance must be into the upcoming, IDD2. which means that we need to find, for each of the previous, legislative acts, the rules applying to the insurance sector, and then we have to write something specifically addressed to the insurers. The other one is a progressive marginalization of the IDD in favor of our other directives. In my opinion, the Insurance Distribution Directive is flexible enough to manage all the issues arising from the upcoming regulation. This general principles such as honestly, fairly, and professionally, best interest, transparency, proportionality, are able to manage this issue and to adapt the upcoming legal framework to the peculiarities and to the risks which are specific to the insurance sector. However, we must be smart, regulators must be smart, manufacturers, insurers must be smart, distributors too. I know it's challenging, but this is something that we need to deal with, because the IDD, this is the conclusion, translated into the business conduct the same principle we are applying with the reference to the prudential supervision. In the prudential supervision, we have the forward-looking approach, which means that we have to look at the potential risks which are affecting, the solvency of our insurance company, which means that we need to include in the quantitative requirements the calculation of underwriting risks, of market risks, credit risks, operational risks, including legal risks. However, if I read the Solvency II, I understand that we have also to have in place an effective system of risk management, which includes governance, which means that we need to include in the managing of the risks also the distribution risks. So reputational risks, as they affect the reputational risk and the strategic risk. That's the reason why oversight governance and the need to manage these distribution risks are asking insurers and regulators to look at the forward-looking approach when they are approaching the business conduct. Because at the end of the day, the IDD is the first directive which will apply the principle introduced under Solvency II, which is the main scope of insurance regulation and supervision in the European Union is customer protection. And we can protect customer if we anticipate this protection. That's the reason why I think that there is a gap when we exclude, the ancillary intermediaries, and I think it's challenging for all the industry to implement measures which try to give us a better knowledge of our customers. However, it means that we cannot say in case of the event, oh, I'm sorry, I didn't know anything because I didn't know anything about your risk exposure. So that is one of the challenges of the digital transformation. Thank you for your attention.